Hello everyone, welcome to our discussion, part 2 of our discussion about Schedule C and self-employment income, business income if you will. Today, this one we're going to deal with depreciation. So the idea is that we have bought an asset that is going to be used for more than 1 year. So it's going to be a cost. We spend a lot of money on it, but we have to use it up over time according to the depreciation rules. So this is similar to the idea in depreciation that we learned about in regular accounting classes, but in tax-wise, it's going to be entirely driven by what the tax rules say. Okay, and they're going to have lots of different application depending on the type of asset and that sort of thing. When you buy it, all those things are going to be part of calculating depreciation for tax purposes. So, first of all, to be able to calculate depreciation, you need to know what the basis. That's usually the cost, what you paid for it. That it would include any cost necessary to get it ready to use, for instance, sales tax or shipping or installation, that sort of thing for certain things. But there's also situations where it would not be what you paid for it. It may actually be what the value of it is when you convert it from personal use to business use, because we're still talking about business assets, right? And the same thing applies. Was it necessary for your business that we talked about in our podcast number 1? Now we're applying it to the asset. If it is used necessary in your business or other income activity, then we calculate depreciation. If it is personal use or not business use, then you don't get to deduct depreciation. If you convert an asset from personal use into business use, all right, then you have the situation where you use something other than its original cost as the basis. It may be the fair value at the date of conversion if that happens to be lower. Now, we do have in this scenario and any expense scenario, the possibility that we could split it between personal use and business use. So an asset that costs $10,000 that's used half for business and half personal, we literally just treat it for the business part of it as if it was an asset that cost $5,000. So when we say basis, we mean the part of the asset we paid for that is business use. Where that can get really kind of, you might say, messy, is if that business use changes year to year. Now, if your business use is the same through the whole time you have the asset, it's relatively straightforward. But if that changes, then you have to rethink your calculations, and that can be a little messy. So depreciation period, how long, the concept of useful life. So you need to know what the cost or the basis is. You need to know what the useful life, how long are we going to depreciate it for? We really thought about this back in regular accounting class, but in tax law, all assets are placed in specific class lives. So the tax law tells you, you look up the type of asset and it tells you exactly how long you should use depreciation for. So very little judgment in that regard. It's pretty easy to look it up and apply the appropriate life. We have what's called depreciation conventions. What do we do with assets that are bought during the year? So do we have to calculate part of the year depreciation, or what do we do? Well, to try to make life easy, they have built depreciation tables. The depreciation tables that are provided to you in your textbook assume the half-year convention, meaning that you have half of a year of depreciation in the year you bought the asset and the half year at the end. You don't, if you use the tables to calculate, don't have to worry about the half year on the purchase side. You will need to make an adjustment on the sale side because they have not built that into the tables. And unless you, if you sell it earlier, meaning than what it was expected to be for the useful life. Now, the half year applies to most assets, but real estate, you have to use mid-month. Mid-month says you calculate depreciation as if everything was bought in the middle of the month. So if it was bought in March, you treat it as if it was bought on March 15th. So in 2021, if you bought an asset on March 15th, all right, you would depreciate it for, it would be 9.5 months. All right, so half of March and then April through December. That's the mid-month convention. All real estate does that. And mid-quarter is only used if you buy more than 40% of your non-real estate assets in the last quarter of the year. So remember, the half-year convention is kind of assumes everything is bought halfway through the year, which seems like a good average, assuming you buy your assets kind of here or there, whatever, during the year. But somebody said, oh, I'll just wait till the end of the year and buy a bunch of assets. That's not going to work. In terms of using them half year, you're going to have to use the mid-quarter if you buy too many assets in the last quarter of the year. And then there's a method, typically double declining balance, that we learned about in earlier accounting classes, but you also may have situations where straight line comes into play. And again, it's all determined by the asset type and the tax law. Okay, so we do this for Schedule C, and we'll do work on rentals in a couple of weeks, and we'll have that same depreciation calculation issues for Schedule E, which is where we do our rental income and expenses. So, basis. Purchase basis usually equals cost. If you convert from personal business, it's either the lesser of the fair market value or the cost. Remember, the lesser of the two. If you did it on a non-taxable exchange, and in a later chapter we'll talk about how that happens, but just note that when you use, the non-taxable exchange, your basis is going to be cost, less any deferred gain. And if you inherit an asset that you're going to use in business and they're going to take depreciation, your basis is a fair market value at the date of death. All right? And so that's what you would use to calculate depreciation. Here's how the class lives kind of work out. This is the most common. Very few things go into over 3 years. Lots of things under 5 years, all autos, trucks, computers, any computer-like type things. And then a whole bunch of stuff under 7, furniture, fixtures, equipment, machinery, all that stuff. There is a 10-year, a 15-year. They don't have as many things in those class lives, so we haven't shown them. 27 and a half years is for residential real property. So you're renting to individual families, that sort of thing. That's residential, where they live. And non-residential, 39 years. Okay, remember those last two. Those are going to use straight line, mid-month. Okay, but non-residential is commercial, like stores or restaurants, that sort of thing, as a non-residential real property. We talked a little bit about the depreciation convention. You will have to make special calculations in the year of disposal, but the convention stays the same through the whole. Once you use the half-year convention, it applies for that asset till the end. Same thing mid-quarter, mid-month. Okay? Half-year assumes everything is bought halfway through the year, already built into the tables. Mid-quarter, you have to look at the extra tables, only involved if you buy too many assets in the last quarter of the year, more than 40% of the total, and mid-month for all real estate assets. Okay, so not going to spend a lot of time on the depreciation methods. Just use the maker's tables. Okay, just use the tables. And now here's how you use the table. The tables are given. You take your basis, the cost of the asset, you multiply it by the percentage in the table based on the year that you're in. So if an asset was bought in 2019, for 2021, you are calculating the third year of depreciation. So you go to the table, you find the column that has the years that it's supposed to be used, the class life based on the type of it. So if it's 7-year property, it's a piece of furniture, you go to the 7-year column, you go down to the third year, you take your cost of the asset and you multiply it by that, and that gives you your depreciation for that year. All right, if you bought it in 2021, all right, then you're going to use the first year, right? So you go over to the 7-year column, you go down 1 to the first year and multiply by that factor times your amount that you paid for the asset. Straight line is just calculated using straight line. What we learned, no salvage value, just take the cost divided by the number of years in the useful life. 150 declining balance, very seldom used. Used for some specialized assets, the 10 and 15 year assets that we don't come across very often. Now, besides the regular depreciation, there is a belief in those who write the tax law, Congress and other places, that if you give businesses special depreciation, extra depreciation amounts, that they'll buy more assets and therefore hire more people and therefore create jobs. So they always are messing with, I should say, these depreciation calculations or issues to try to give people more incentive to buy assets. So one of those is what's called Section 179 expense. So we learn depreciation. We say to ourselves, depreciation is for assets that are going to be used over time, and so we're going to calculate depreciation over time, multiple years. Section 179 says for special assets, certain assets, we will allow you to take the depreciation for the whole amount that you paid for the asset. So it's like 1 year useful life kind of thing for assets. Doesn't apply to real estate, has to be non-real estate assets. But there is a limit. You can only do it in 2021 for up to $1,050,000 of assets. That's a lot for most small businesses. That's going to cover everything they're going to buy easily. But for bigger businesses, that's no big. That's not even a drop in the bucket. So it's not even that important. Okay. What the other limit that you should realize is if you use Section 179, you cannot create a loss. You cannot have more expenses than revenue. So sometimes if your income is low, it would not make sense to use Section 179 because it would be limited because of that situation. Okay. The other special depreciation rules is bonus depreciation. All right. And that is 100%, just like Section 179. It can be up to, it's 100% of the cost of the asset. This is only for assets with less than a 20-year useful life. So no real estate again, okay? No real estate, but everything else basically qualifies. Makes basically all assets such that you don't need to calculate depreciation. If you buy it in 2021, you can take 100% depreciation and you don't have to worry about using the tables at all. Okay, in those situations. And it's broader than Section 179. For instance, Section 179 can't be used for an asset you rent to someone else, but this one can be. So it makes 179 not, and there's no limit. You can as much assets as you buy. So this is a situation where we truly feel like that if we let people buy assets and deduct the whole cost of them, they'll actually buy more and build jobs, that sort of thing. One problem is that there is still limits if it is an automobile, luxury automobile. There are still limits, okay? But almost anything else other than real estate, this applies to. Now, regardless of what kind of depreciation you calculate on, there are assets that are referred to as listed property. All depreciation is reported on a Form 4562. And then you calculate depreciation on that form and then move it to the Schedule C. Okay? Listed properties are put on page 2 of that. Listed properties are by definition of tax law those things that have both a personal and business element to them. So autos are listed property. Boats are listed properties. Okay? Those are the kinds of things that the IRS is very suspicious of you having entirely for business. So they're going to make you list them. That's what we call listed properties every year. If it's a not listed property, you list it only in the year you buy it. You list it that year, and then after that, it's just kind of summarized on the form. But listed property has to be listed every year you own it. Okay? So then there's some limitations on this listed property. You can't use Section 179, okay, if you use this asset for less than 50% of business. Okay? And you have to use straight line depreciation if it's a listed property and use less than 50% of business. So, of course, your goal, of course, is to be over 50% of usage on that listed asset. So, we mentioned earlier this luxury automobile limitation. For automobiles that are less than 6,000 pounds gross volume weight, basically anything that's not a big SUV, any regular automobile, certainly any of your regular passenger vehicles, there's a limit on how much depreciation. Doesn't matter whether you calculate depreciation using bonus depreciation, using Section 179 depreciation, or the regular depreciation calculations. This is the maximum you can deduct for each year for an asset you bought, for an auto you buy in 2021. That is if you are going to use the bonus, you still only get $18,200. So if your car costs you $20,000, you can only deduct $18,200 in the first year. if your car costs $100,000. The only amount the maximum you can deduct in the first year is $18,200. If you don't use bonus depreciation, it's only $10,200. So if you buy an auto for $100,000, you would depreciate at $18,200 year one, assuming the bonus, $16,200 in year two. So in 2021, you do $18,200. 2022, you do $16,200. Okay, year three with $9,800. That would be 2024. 2025 and a year after that, it would only be $5,860 each year until it is fully depreciated. Which, if you bought a car for $100,000, is going to take a whole bunch of years. Okay. If you buy an SUV that's greater than 6,000 pounds, technically there's a limit for Section 179, but no limit on the 100% bonus. So you don't need to worry about the Section 179 limit. And then our last piece about depreciation, if you lease a vehicle, or instead of buy it, all right, and that's sometimes particularly advantageous if it's an expensive vehicle to lease it. All of the lease, okay, is not deductible. There is a part of your lease payment that must be computed and included in inventory in your income. Basically, you just reduce your lease expense by a set amount. There are tables to calculate it. You have to know what the value of your vehicle is. You have to know what your payment is, and then you can make that calculation. Okay, that gets updated every year in a revenue procedure. For 2021, it's in Revenue Procedure 2021-31. That tells you it's the 31st Revenue Procedure for 2021.